Well, greetings and thanks for joining us. We're ready to begin here. And this is really about succession. And this is helping owners and leaders grow, go, or let go. Thanks for joining us today. I had a light bulb moment about 3 weeks ago. Actually, it was about 3 light bulb moments where within a short amount of time, several people had come to me or called me. I was on a plane with someone, and I heard in very short order about several situations where salon owners were very stuck in terms of what to do with their business, in terms of what's next. And in certain cases, they were considering closing the business. We also had something that kind of shook me, didn't really shake me, but just kind of created another light bulb moment, is we got an email from someone we barely knew, relatively unseasoned owner, and she was closing the doors. And I think it just was the wake-up call that we really got to get this information out to the public. And so on Light Bulb Moments, which is a podcast I do every Wednesday, I started talking about succession stories, case studies, etc. But we decided to go a little bit deeper into that. And the light bulb moment was to create a series more in the interest of public service than anything else, to help get information out there on what it takes to have a successful succession. And these stories about closing businesses, it doesn't need to happen that way. And our goal always has been to have all parties be in an even better place in the future than they are today. So this is a 3-part series. Our first part was on May 8th, and the recording is available if you didn't listen to it. And that was what you should know about selling your business, which is the theme of the entire series. But this one really dealt more with succession myths and traps. We went through several of them. There was about 8 to 10 of them. And we also went through how you really identify what your why is and how to really fuel progress, taking small steps towards whatever your future looks like, whether it's to grow, let go, or go. Today, we are going to talk about a favorite topic of mine, and that is understanding valuations. How much is your business worth? And I'm super excited about this topic, and I have educated on this topic for a very long time. I have reviewed several valuations. I personally have not performed formal valuations, but I have done many, many valuation calculations throughout the last 5 to 6 years. And today, in part of my preparation, I actually went through a valuation that was just done for someone we're providing some guidance on, all 46 pages of it. I have reviewed this report over the last few weeks, but last night I sort of geeked out on it, read every single page. And so today we're going to feature some new content. And the topic again is valuation matters. This is actually, most of this is part of a lot of this series is pulled from our succession workbook, which is how to know, plan, and do a successful succession, even if it's just to let go. So we distinguish between a full exit, partial exit, and everything in between. And as part of this course that we teach, it's full of 9 grids checklist. We invite technical advisors. I think today we have joining us in the background, Kevin Lightheart, a CPA, who we've worked with. Kevin does a great job educating on the tax and other financial aspects of it from a CPA standpoint. And we also go through common topics related to transactions. And I think what people really like about the workshop that we do is it's full of case studies, salon-specific case studies. And anyway, now, before I go any further, reminder, this workshop's for general education, and it is not a substitute for advice from a professional advisor. Each situation is different and unique. Use common sense when applying this education and the case studies shared. And also, as it relates to the topic of valuations, the examples and multiples that I'll discuss are for educational purposes only. These are not valuation advice, shouldn't act on it. And I'm going to get into things such as multiples, et cetera. They are not the opinion of myself. We are not valuation professionals. Instead, seek the guidance and advice of qualified business valuation professional. We are here as educators. All right, so I've got a 9 grid I'm going to take you through today, and I'm going to keep this at about the same length that we've been working towards, somewhere just shy of 30 minutes. So I will start with number 1, valuation is the KPI no one is talking about. If you think of key performance indicators in your business, there's top line indicators, there's bottom line indicators, and there's everything in between. But arguably, this could be the most important key performance indicator, which evaluation is. It is an indicator, could be one of the most important ones as an owner. And the reason why I call this out that no one's talking about it is focusing on your valuation as a key performance indicator has several byproducts to it. In order to have a high valuation, a lot of positive things need to be in place. Keep in mind that the valuation as a key performance indicator is very dependent on the performance of the company. So where I'm going with this is it's good business to focus on the valuation KPI, because the things that build a high valuation are the things that are needed for the business to be successful also. So there's a byproduct of focusing on it. And even if you have no intention of selling your business, even if the valuation isn't meaningful to anybody else, it does give you a call to action to really address this key indicator. And again, I say no one's talking about it. I have a prediction. I think more people are going to be talking about it, because as we've shared in previous workshops, is that we have a tsunami of transactions that will occur, given the fact that approximately 2/3 of small businesses, keep in mind, small businesses make up about 99% of the economy, 2/3 of them are going to be ripe for transition simply due to owners aging out. So tsunami of transactions coming. It's best to be ahead of that curve, regardless of where you are in your owner journey. Number 2, we're going to go to valuation rule number 1. And the rule is the true valuation measurement is what a buyer is willing to buy it for and what a seller is willing to sell it for. These are competing forces. And this is where the formula isn't often the number that's used in a transaction. A lot of feelings go into a valuation number, and those feelings can't be ignored. I'm going to talk very specifically about formulas in a moment here, but what happens is many times there might be this formula, this calculation, but at the end of the day, the owner has her or his number. And that number might come from something completely non-formula related. I'm going to give you some examples. Some might just say, I want what my remaining debt is for the business, and that's the valuation. I want what my recent build-out cost. I want what it costs for me to retire. I want no less than this. Now, not necessarily formula driven, not standardized, but at the end of the day, I recall one of many case studies, meeting with Amanda Hare and Bob Steele about their transaction. They've been frequent guests. We've done case studies on them. And I've interviewed them. And I asked Bob, I said, Bob, you had all these different formulas and whatever. At the end of the day, did you use the formula or did you have your number? He said, I had my number. Okay, well, that's a reality. But let's go beyond rule 1, which brings us really more into reality. In many cases, formulas do matter. And formulas matter for several different reasons. Is, for example, if there's outside financing, small business or SBA loan is a perfect example, Small Business Administration, particularly a loan that's called a 7A, they require evaluation, and the financing arm, whether it's a bank or some party, is going to be very, very tied into what the actual formula says. And in many cases, that's going to come from a formal valuation. Now, again, I just recently went through a 46-page formal valuation, and there's a lot of lessons in that. But formulas definitely do matter in most cases. And while the buyer or seller may override that, I think it's important to really go deep into the formula, which I'm going to get to right now. So let me take you through the most common formulas that are used to evaluate a business in this space. And when I talk about this space, I'm talking about a salon, a spa, could be a service clinic that would be in a like field, such as a studio, fitness studio, etc. But really staying in the lane of salons and spas that, unlike other industries like tech, where in many cases the valuation would be a multiple of sales. For example, certain tech companies might sell at a 5 to 8 times their sales because it's a recurring revenue model, et cetera, et cetera. But in this space, the most common formula by far is a multiple of earnings. So let's break that down into 2 steps. Number one is we have to have a measurement that most closely approximates earnings and cash flow. And there's two specifically. And for those of you that I worked with in the past, I have some new understandings and some new ways to communicate this. So first of all, part 1 of the formula is going to be EBITDA, which is an acronym that stands for earnings before interest, taxes, depreciation, and amortization. Really what that is that's a measurement of earnings. You take net income from the business and you add back certain things like interest, taxes, depreciation, and amortization. Most of the businesses represented in our community that really can be abbreviated more to earnings before interest and depreciation. So that is a very common measurement, EBITDA, or a more refined version of that if there isn't taxes or amortization that are factored in. Keep in mind, by taxes, we're talking about income taxes, not payroll taxes. So EBITDA is the first part of the measurement. However, there's also a slight variation of this, and that's called seller discretionary earnings. Now, what is the difference between EBITDA and seller's discretionary earnings? And I don't know that I've been as clear on this in the past with people I've worked with. So essentially, seller's discretionary earnings is EBITDA with add backs or deductions for things that are very specific to the situation and very specific to the seller. For example, what that would result is an add back of things that will go away when the new owner buys the business. For example, a car that is being run through the business. It could be life insurance that's being run through the business. It could be some travel that certainly has a business element to it, but a strong argument could be made that that travel would go away if the owner takes over. There's also things like charitable contributions, which could be seen as discretionary. So the first part of the formula, again, is either EBITDA or seller's discretionary earnings on a more practical basis. And usually more to the advantage of the owner is to use seller discretionary earnings. Now, there's a qualifier for that I'm going to get to in a little bit because it's not quite that simple. But let's start with the simple formula. So step 1 is we have a measurement of earnings that most closely approximates cash flow, because that's really what, in most cases, the owner's buying. In the case of a salon or spa, there's really not many assets to be purchased. The primary asset to be purchased is goodwill, which is everything that's gone into making this a successful business that's non-tangible, which is client list, reputation, branding, marketing, all of the different things that really you cannot attach. It's not something you can touch and feel. And that is the most significant asset for most of these businesses. Other industries, there might be things like a really high inventory, really high equipment, and other tangible things. But anyway, again, first part of the formula is a measurement of earnings that approximates cash flow. The next part of the formula is to use a multiple with that. So some multiple of seller's discretionary earnings, for example, times a number. Now, what are multiples that are used in salons and spas? Well, and here's where I want to make a statement about the difference between EBITDA and seller discretionary earnings. EBITDA, using that measurement, will typically have a slightly higher multiple than seller discretionary earnings. So they sort of equalize out. So it's going to be probably be a higher number, seller discretionary earnings, but it might be a slightly lower multiple, whereas EBITDA may not factor in seller discretionary items. It might use a slightly higher multiple. Now, what is the multiple? Well, there's a wide range here. And I've had some recent lessons on this one, and I'm holding some data in my hands here that really looks at a multitude of transactions from a valuation report and other databases that I'm aware of. And the multiple for EBITDA or seller discretionary earnings on the low end could be in the neighborhood of 1.5. On the high end, it could be in the neighborhood of 5. Now, where does it land in the middle and all of that? Well, typically what's going to happen, especially for a formal valuation, what is going to be published in the report is really different percentiles. So there's low, there is the lowest 10%, the lowest 25%, then there's average, which is median or average, then there's the upper 75% and the upper 90%, and then there's high. And that range is very, very wide. And that's where I want to spend some time talking about how to be on the high end of that, and with some recent lessons on that. So now everybody says, all right, well, what's the average? It's the data that I'm holding in my hand is very similar to, well, even though some of the data that I have in my hand is relatively recent access for me, throughout the years, I've always suggested that 3.5 is a very much an average number when we're looking at EBITDA, and seller discretionary earnings probably slightly less than that. But again, that range is quite wide. In dissecting a recent valuation report for someone that we are providing some guidance on, and we were not really involved in the valuation other than making an introduction. We partner with someone, don't really partner with someone. We refer someone to that has in the space of valuations and has done salon valuations and provides an affordable solution. And I was surprised that this company was put into a lower percentile. So, and it was in the lowest percentile, it was in the bottom 10%. And that's where I think the lessons come, and something I want to make sure that I get out there. So I'm going to come back to that more in a little bit here. But first of all, the formula is going to be it's going to be a multitude of earnings measured by either EBITDA or seller's discretionary earnings, time some multiple that varies widely in range due to a variety of different factors. Now, ranges, I spent a little bit of time talking about that already. We can see low end, high end. I want to get to something that, other matters and other things that go into it, because here's where the subjective element comes into it from the valuation specialist. Now, the valuation that I reviewed and I'm referring to was done by an expert firm, all the credentials, but they used a lot of the narrative. There's two big dings, couple big dings. There's some other ones, but one is, and this is so interesting, the narrative that is supplied to the valuation company does matter. I mean, they read it, and it could work in your advantage and your disadvantage. And the narrative, in the case of the valuation I reviewed, was perceived to be negative by the valuation firm. They interpreted certain activities and certain things that were happening in the business that the owner thought was positive actually became a strike against them. And then let's talk about momentum. Now, this is a big one, and I've always suggested that momentum really matters in valuations. It matters a lot. And in this particular case, this company did not have strong momentum. Sales were down and profits were down. This really, really hurt this valuation. And one of the ways it hurt the valuation is, in most cases, the valuation should not just consider 1 year. The valuation should consider multiple years, very often 3 years. And a weighted average is a very common way to do that. So you would take the most recent period, let's say it was last year, and you would assign a weight to it, probably a higher weight. Then you would look 2 years ago, that would have a weight established, probably lower than the most current year, because the most current year is the most relevant. And then the third year, it's weighted less. In this particular case, they weighted 100% of the valuation on the prior year, which was the worst of the 3 years. Substantial cost in the valuation and a huge ding in it. So point here is that, and we're big believers in being very proactive and taking the steps today to build a valuation in the future. And this is why momentum is something to pay attention to. And again, I go back to the very first point I made on this 9 grid, and that is the KPI no one's talking about is the valuation. And working on your valuation has tremendous byproducts because it's just good business. And I'll talk to you about some other things that really drive valuations. So anyway, narrative and momentum matter. All right, other matters that I have for you today, just a few other comments is, what goes into evaluation is when someone's actually performing evaluation is intended use. The valuation experts will want to know what the use of the valuation is. In many cases, it's for a transaction. You have a willing buyer and a willing seller. And in certain cases, it's because one of the Ds, death, divorce, departure. And so they will pay very close attention to why they're performing the valuation. The other thing to mention in valuations that many people may not know is a discount is inherently provided in many cases. There could be a discount that relates to the lack of marketability, which is true for most small businesses. They're not as marketable, for example, compared to like a public company where you can go in and publicly trade ownership. Small businesses are illiquid. It's not easily to convert them into cash, and that often cases results in a discounted valuation. The other thing that might result in a discounted valuation is controlling interest. A controlling interest would be worth more valuable. If there's a lack of controlling interest, it tends to create a bit of a discount. Things that go into evaluation or what needs to be submitted, certainly prior year tax returns, company financials, the owner's situation, leases, add backs, a lot of things go into that. Inventory. Where does inventory come into this? I'm going to save that one for a later day because there are some surprises on that one. And I think it's beyond the scope of today. It's something we cover in our course. We dig deeper into it, but inventory is definitely an area that's misunderstood by many. Gift certificates also has a huge impact on an eventual transaction. And let me see what else I have for all of you today before we wrap up. Some of the other things that matter when it relates to evaluation is going to be financial house in order. And if the financial house is not in order, it's going to impact the valuation, and it's also going to impact momentum. Real estate's a big one, owner dependence, location, et cetera. And what I have tried to identify is what are the key drivers to valuation, and I've got a handful of them, and I think this is where I'll wrap up. Certainly performance. Performance is number one when it comes to valuation. Performance in earnings, but sales is looked at because of momentum and what have you. So performance is number one. There's definitely leadership, very much. Is their management team in place? How seasoned are they? Will they stay with the transaction? Owner reliance can work one way or the other. Lack of owner reliance could be a positive or a negative. Lack of owner reliance could be a negative in the sense that the owner has really checked out and the business is starting to, it's showing in lack of momentum. But in many cases, lack of owner reliance would be a huge positive, which means that the next owner of this business doesn't have to go through all the pain and agony of replacing the owner, whether it's from a revenue standpoint, leadership standpoint, or whatever. And then we also have things like solid systems. That's why we love 5 functions, because it gives you a very structured way to look at the systems of your business. So anyway, that's what I have for you today. I'm going to remind you that we have one more session left. We're going to take next week off on May 29th. We're going to be going through Achieving Succession, Business and Owner Readiness. And I will tell you what many talk about in the exit planning community is business readiness and owner readiness. But one of the things that we also like to talk about is a third leg to the stool, and that is buyer readiness. No one else talks about buyer readiness. They just talk about business and owner readiness. And when we dig into it, because in most cases, most transactions that we see, they're by key employees. And we share in our course, we actually have 9 grids for business readiness, seller readiness, owner readiness. And we also go through something that we call 13X, which is a systematic way to take small steps over 13 quarters to get your business succession ready. We've created a new tool around this. We partnered with Heath Smith, who's one of our lead coaches and advisors. And he's the one that really helps develop an execution plan. So you chunk away 1 quarter at a time. 3 years is usually a pretty common time frame if someone's really wants to get the business succession ready. It could be shorter, could be longer. But what we have now, which we've never had before last fall, is a more systematic way to do this. All right, well, that's all I have for you today. Feel free to join us on Lightbulb Moments, which is every Wednesday at 10 a.m. Central Time. And thank you for joining us today. I'm going to leave a few minutes here for some questions. I will check the chat. And thanks for joining us, whether it's live, whether you're listening to the recording. We want to give you some hope and optimism that you can make this business of your dreams, not only today, but also for tomorrow. But it does result in taking action, and action starts with education. So thanks for taking your precious time with us today. Thank you very much, and I will check the chat for any questions. All right, let's see here. What do we have? I'm going to scroll back here. Okay. A negative narrative. All right, so a negative narrative, an example is a narrative around a decline in sales. And what is the explanation behind it? And in one case, what I'm referring to is the valuation firm interpreted the owner's lack of involvement to be negative. But it was all how it was positioned in the narrative. So earnout period to meet evaluation. So earnout is the payment of the sale of the business over time, as opposed to one single transaction. And an earnout period can be, an earnout period could vary greatly. Sometimes an earnout is going to be tied to a separate agreement that is embedded in the valuation. And that has to do with how long the owner is going to stick around and what the owner is going to do. In many cases, instead of one big lump sum, the owner will be paid over time as part of an earnout. And that is in return for the owner to be continuing to provide services. Let's see what else we have here. For outstanding liabilities, gift cards, is there a particular percentage that a current owner should shoot for prior to selling? In other words, if there's 100,000 in liabilities, a target to redeem. Okay, so I want to take outstanding liabilities and gift cards separately. So first of all, liabilities is the obligation of the current owner. So if the sale of the business happens, generally, if the buyer takes over existing liabilities, that is a reduction in the purchase price. as it relates to gift cards, is there a percentage that a current owner first shoot for? I think that's really beyond the scope of me being able to answer that today. Please forgive me. How can you get access to last week's recording? That came up. Buyer and seller readiness. Oh, buyer and seller readiness. We're going to tackle that in 2 weeks. So I just did just a quick synopsis of that. Just it was a quick screen share. Let me see what else is here. I think we've covered it today. So thank you for I view gift cards. Yes. Oh, yes. Gift cards and gift certificates are indeed liabilities. I wasn't suggesting they're not liabilities. I suggested that gift cards and gift certificates are a deeper dive into it. So yes, they are definitely liabilities. And I will give you just a quick synopsis for this. So yes, they normally, outstanding gift cards or gift certificates are a reduction of the purchase price. And having said that, the accounting around gift certificates, and here's something I'm going to say to you, is that get it under control from a standpoint of a measurement. I've seen deals slow down because of gift cards alone. That the current owner essentially was saying gift cards were very low and they're not material. However, the buyers come in and say, no, wait a minute, there's more gift certificates outstanding than you realize, et cetera. So there is quite a bit of back and forth on that. I'm going to take this last question, which I love this one. It has to do with real estate. I own both the building and the business. Where does that land? Thank you, Melissa, for that question. I love that one. And and I'm sure Kevin Lightheart, the CPA, would chime in this one, but I'm going to jump in on this one. And that is, they are two different business models and two different valuations. And, having them in separate businesses is vital. And I've actually seen transactions delay by up to 2 years because real estate and the business were in the same company. And it's really important to understand that they have different methods of valuation. Real estate is going to come through an appraisal, a third-party appraisal. And in certain respects, it's easier and more common and accessible to get an appraisal on a piece of real estate than it is in a business. So they absolutely have different valuation methods and formulas. And in many cases, they are not part of the same transaction. Business is sold, but the current owner still keeps the real estate and maybe has an option for the new owner to buy it. And so that's a little bit on real estate. So, all right, everybody, I think we're at our time limit today. Thanks for joining us today and hope to see you in 2 weeks. If you like this, share with other people. Push it out. I really think this information is important to get out to the industry. And we have, certain people, this is a pain point, but we don't want this to be a pain point. We want this to be a point where you're able to move into what's next for you. So that's all I got for you today. Thanks so much and hope to see you all very soon.